within the region, but we are positive on India, we are positive on Indonesia. We actually have a mix of North Asia and South Asia, kind of a barbell approach in our allocations. To your point, Sri, I think North Asia obviously is more a function of, which includes, by the way, Japan, but not just Japan, but Korea. It's more a function of corporate change, but also our expectation that the memory cycle and the tech cycle is recovering, and so you'll see earnings coming through, which is, by the way, already happening, right? So the December quarter earnings season, which is still underway in some markets. In Korea's case, the profits have jumped from a very low base, more than 100%, like 113%. So our view has been that of cyclical recovery in Korea, and that's already started to happen, and we think that will continue, right? So it's a more fundamental sort of memory cycle, tech cycle driven recovery, and we think that can still play out. At the same time, I think India and to some extent Indonesia is more in a structural camp. And there, I think the key story, for example, for India is that there is consistent earnings delivery there, right? The pushback, for example, you get on a market which is expensive is that,
yes.
I mean, on valuations, but basically, if you look at last year, India printed 20% earnings growth, and the market was up 20%. So the entire move last year, or the rally, was driven by earnings accrual. So for these sort of growthy markets, if underlying earnings does come through as we expect, there is still room there. So I would say our views are less dependent on how the political scenario in shapes out in that sense.
Sunil, just a quick line on the outlook for the Indian market. Upgrades, credit rating upgrade could be coming. We got the election to get through, and there are some concerns about a majority by the BJP and Prime Minister Modi and re-election. There's bond inclusion as well. Is all of that in the price, or is there potential to gap higher?
So, as I said, I mean, so let's talk about sort of equity versus debt markets very quickly. So, as I said, in equity markets, the entire move last year, which is a 20% rally that the market saw, was entirely driven by earnings accrual. So there was no multiple expansion in the last 12 months in aggregate. So the market is trading at 22 times forward, which is the same level it was a year back. So our sense or our math here is that we expect earnings to grow 15%. Even with some sort of modest compression in multiples, we think markets can be 8 to 10% higher over the course of the year, which is what our targets are, right? So we remain constructive on equities, and the macro is looking fantastic there. On the inclusion, obviously that starts from June. We think that will get you around 30 to 40 billion inflows, which, along with the good situation on the current account, keeps your balance of payment under control, right? So I think you will have, therefore, bond rally on the back of that. So we are actually positive on Indian equities, Indian bonds, as well as INR. So all three asset classes we are positive on in India.